What is going on, investors? Hopefully you guys are having a great day out there. Time to talk about Lyft Incorporated, ticker symbol LYFT, popular ride-sharing app here in the United States. Now, market cap on this one's $18 billion. Got a 9% short interest, but guess what? Nobody cares because over the last year, this stock is up just 92%. Year to date, up 16%. So when we get over to the stock chart on this one, we'll see a stock that is been ripping back to the highs it made when it recently went public. We'll talk about that broadly here in a second. We'll also go over the Q1 earnings, which just came out just moments ago. We'll talk about the revenue, the profits, the cash flows, and all those types of things. Now, Uber and Lyft are constantly in the news, and recently the U.S. labor head supports classifying gig workers as employees, and that would be Uber and Lyft drivers. Now, we've seen legislation like here out in California get shut down. We've seen it in other places, New York, other places around the world. Constantly, government officials are trying to classify these gig workers as employees, get them benefits, get them those types of things. But what they typically leave out is, what is this all about? It's all about taxes, baby. It's all about that payroll tax, income tax, and things like that. And so we'll see how much legs this has. When you read through this statement, this headline seems pretty grim, but when you read through his statement, it doesn't necessarily mean that it's something that's going to happen. It's also not necessarily something that the United States government can really push through without a lot of opposition out there. We actually saw that out here in California. Now, here's probably a bigger issue with these companies. Okay, when Lyft and Uber went public, the big talk was, yes, these are ride-sharing apps. The trend was going that way. The pandemic kind of put a little speed bump, so to speak, in these business models. But now they're starting to get back on track. And when we get over to the numbers here, we'll actually see evidence that it's getting back on track. But when these companies went public just a few short years ago, everybody was talking about how this is not a ride-sharing app. It is a self-driving company. It's a company that is going to develop self-driving technology. And then, in that case, they don't have to worry about U.S. labor or California labor or New York labor or any of these labor groups because they were going to have robots driving the car. Well, guess what? Lyft sells their self-driving vehicle unit to Toyota's subsidiary for $550 million, and that accelerated their profitability. So in the short term, this is helping Lyft. It helps their balance sheet. It helps their profit. But broadly, why in the heck are we buying Lyft and Uber stock when this is what these companies sold us on in the beginning of their lifespan, that they were going to be becoming self-driving companies and these big technology companies? Now all they are essentially apps to connect drivers to passengers that need a ride. Is this a business that you want to invest in? We'll talk about that more here in a second as well. Now, comparing Lyft to Uber, I got a price to sales. Neither company is profitable, which I think they are. If these companies were private, I think they would still be accelerating their self-driving investment. But because they are public, they have to develop profitability in order to maintain investor interest. And we've got a price to sales ratio that has accelerated actually over the last year for both these companies. They are a very similar. Uber trades at a slight premium, possibly because they have Uber Eats and some other little business models that make it slightly more diversified than a Lyft. Now, moving over to the balance sheet, let's take a look at what Lyft has got going on. They got the current assets here, cash and cash equivalents here, sitting at about, we'll call that $2.2 billion. That's where it was at the beginning of the year. Right-hand column is the beginning of the year. Left-hand column is the most current quarter that has passed. Now, all things being considered, assets relatively asset-light company. Again, a company with an $18 billion market cap, and we've got total assets sitting at $4.5 billion. It's not a lot, honestly. Do have a little bit of long-term debt sitting on the books on this one at $650 million. Well in control. And the fact that they've divested their self-driving ambitions could lead to that number staying about where it's at. Now, let's take a look here for the last 3 months. This is our revenue and the profit. I'm going to expand on why they sold their self-driving and why that could lead to competitors coming in the future. So we've got our revenue here. We've got last year at 955 down to 608. So we're still down year over year. Okay, people are not back at the office yet, and they might never go back. People have fled the big cities. I mean, San Francisco, you go there, it's a dream driving to San Francisco. Now, it was a nightmare before. Now it's like, oh, I got to go to San Francisco? Cool. There's not going to be as much You're still seeing traffic, but not nearly as much when that city was popping. People are leaving the big cities. Look at New York City and those places as well. Now, we've got some other stuff: operation, research and development, sales and marketing, general and administrative. For the most part, everything is down. So our total cost went from, we'll call that 1.37 billion down to, we'll call it $1 billion flat. Now, unfortunately, that did not turn us profitable. In fact, not even close. You got a loss from operations sitting at $416 million loss. That is basically in line where we were a year ago. So some investors might, depending on what side of the fence you're on, is the grass green? Is it dead with this one? Some might say, well, look, we got a nice recovery coming back. Travel's coming back. People are going back to Vegas and all these places, and they're probably going to need Ubers. Well, look, this revenue and profit, they kept it together. They're still losing money, but they're going to potentially turn things around. Now, here's broadly what I want to talk about here to give you like some thoughts that I think a real investor might have. Well, we just sold our self-driving unit to Toyota. So that basically makes Lyft and Uber apps on the phone. Okay. There's really not much more than that. Okay. Drivers can work for both of them. There's not really a big moat around this business other than they have a fairly big install base on people's cell phones. But the reason why they're not facing a lot of competition is, guess what? They're not even close to profitable. They're still losing $400 million running this business. So the minute Lyft and Uber can prove some marginal profitability, they don't have to be profitable. This is pretty deep losses. Okay, on $608 million to lose $400 million, you're not even close to being profitable. But let's say we whittle this down. Well, guess what? Could a competitor like Google or Facebook or Tesla or Amazon or Apple, any of those companies do exactly what Lyft and Uber are doing? I think yes. Okay. And without a lot of these other costs in here, because all this is now is an app on a phone that connects drivers and riders. That is it. Okay. So we'll see if when these companies turn profitable, I know that can be exciting if you like Lyft. It's like, hey, they're going to turn profitable. Well, guess what? The minute this company comes close to being profitable, watch the competition that floods into this space. So we'll see what happens if and when that materializes. Now, moving over to cash flows, pull down this big, gigantic net loss. And this is what some companies could be looking at is, look, they pay this big, gigantic 164 in terms of stock-based compensation, basically flat. In fact, it's accelerated over the last year, despite having declining revenues and profits. So we get to add back that stuff back in, take out some other stuff. Net cash provided by operating activities, negative $80 million. Okay, it's still not enough meat on the bone to get an Amazon, an Apple, a Facebook, a Tesla excited, but I think at some point they will, okay? Because those companies already have stock-based compensation. They already got a bunch of employees. They could put a couple teams on making an app and maybe potentially compete with a company like this. So you got some investing activities. They did some switcheroos on these marketable securities. Not a lot to see there. Now, they did repay some loans during the quarter, and they paid some taxes. They had some proceeds of a stock options. All in all, everything looking about how you'd expect this company. The problem is, they are not profitable. They are not close to being profitable, and they've sold off the unit that gave them a moat around their business. So we'll see what happens broadly. What Tell you what, broadly, investors don't give a darn. Okay, now, yes, if you had bought this stock when it recently went public, you have finally gotten your money back on your shares. That's essentially the range where the stock is trading now. In fact, we have these all-time highs sitting up here at $68. That is exactly where this stock peaked back in 2019, shortly after going public, and it peaked just a few weeks ago, back in March, right almost on the dot of $69. So, as an investor, that should have you a little concerned because sellers stepped in right when we reached the top again. Maybe even some insiders as well might have unloaded some shares when we got back to the top. And now we've been steadily on what I would look to be kind of a downtrend since then. Okay. Now the stock is gapped up. It is looking much better. It is up over in this range where my cursor is, closer to this $60 range. Okay. And so is this a spot where I would want to jump in? No, I have a line marked out down here where I had a level where there should be some support for the stock. Okay. The stock went public and it dropped down to this $47, $48 range. And that has consistently been a range where the stock has wanted to kind of either pivot or do a little consolidation. So me personally, because this stock has no moat around their business, they don't pay a dividend, they're not going to do a buyback, they're not profitable, you got to get this at a good price. And so I personally would wait to see if you get a pullback. You've got some sparse candles here. A pullback into this $48, $50 range would be the first spot where I contemplate buying Lyft. But me personally, the fundamentals just do not line up on this. When you are selling the unit that you were selling investors just 2 years ago for short-term profitability, that's why they sold that unit. Okay, they were burning cash. They were going to have to raise more money, take on more debt. The investors and the management at these companies did not want to take that risk. And I do not like that for companies like this. I want these companies to take risk, to take gambles, and gamble and be aggressive. Lyft is showing me that they are being passive and their management is scared, not being aggressive. On top of that, you got this labor stuff, which will always be an overhang on these companies. And like I said, the minute these companies come close to being profitable, that is when the competition is going to come fierce. And it is likely going to come from the likes of Tesla, Amazon, Google, Facebook, or any number of those companies that are far more well capitalized and have equal or greater install base on people's phones and reach with consumers. I'm not trying to eviscerate Lyft. Look, the shares are up 16% over the last year, 92%. So who the heck am I to clown on a company like this? I'm just giving you where we're at today. Doesn't personally make a lot of sense. I can see why this has 9% short interest, and the $18 billion market cap, given the revenues and the profits or the lack thereof, certainly seems a little rich for my taste. So hopefully you guys enjoyed this video. We'll be back again with more soon. Good luck with your investments.